fact, you will never learn to enjoy true success until you learn to see the big picture. Hi, this is Steve Diggs. This is The Big Picture. Welcome aboard. Listen, on the homepage today, I want to talk with you a little bit about the concept of asset allocation. Now, if you've never gotten involved in investing or preparing for retirement, you need to know about this. On the other side, if you're already in the middle of preparing for your retirement, you also need to understand this very, very important principle. Now, again, there are no guarantees. I cannot promise you that if you do this or don't do this, that you will make more money or make less money. But I will tell you that this is one of the most popular principles among many, many successful investors out there. Again, it's called asset allocation. Sort of a first cousin to this is a thing called diversification. It has to do with understanding that it is extremely dangerous to put all of our investment nest eggs into the same basket. Now again, we hear all the stuff on TV, we hear it from people that are in the money business who say, listen, buy low and sell high. Well, you know, that's fine advice until it doesn't work. And have you noticed that when it doesn't work, they don't know what to tell you? Here's the thing. Some experts tell us that well over 90% of long-term returns are not based on what we think they are not based on what some financial experts even tell us that they are. In fact, much of our long-term returns, probably over 90%, are based not on the idea of buying low and selling high, but instead on asset allocation. In other words, divvying our money up into different piles in different ways. For instance, and again, this is not a recommendation, it's just an example. If you have some money to invest, you might choose to put some of it into a mutual fund that purchases large American companies like American Airlines, GM, companies like that. You might put some of it into a small company, U.S. stock fund. For instance, you might put some of it into stocks that are companies that are less than $5 billion in their total capitalization. You might choose to put some of it into mutual funds that buy companies in other parts of the world. Maybe you'll put some of it into some bond funds, maybe some of it into cash. Now here's the question, does this guarantee me the greatest rate of return? Probably not. If you want to have the greatest rate of return, go to Las Vegas, put all of your money on one number, and just hope that you hit the mother lode. Now again, that is not what I'm really suggesting. What I'm saying is you can make more money that way, but you have a much, much greater chance of losing everything. You see, with good asset allocation, divvying a little bit of money up into all kinds of different pockets, hopefully when one of those investments is going down, others will be coming up, or at least not going down as badly. This kind of levels things out. It helps us get away from that roller coaster that so many of us completely hate. Now again, I wish I were smart enough to come on air and tell everybody in the audience today how to allocate your money. Truth is, I'm not smart enough to do that. I hire people that help me with some of that. But I will tell you that some of the things that you see up on the board here beside me might play into your consideration. For instance, you might think about what your age is or the health that you're at this point enjoying in life, your family status, your goals, your needs in life, your overall financial situation, and also your tolerance for risk. There may be other things that you would want to add to that, but I'll share a secret with you. For many of us, the number one most important thing is going to be this one at the very, very top. It's our age. As we get closer to retirement, you want to make positive that you have a good balance. The old advice still generally holds that as we get closer to retirement, we probably want to take more of our money out of stock-related investments and get it more over into bonds and cash. Now, why is that? Well, stocks historically have averaged probably 10% or more. Bonds have averaged probably a little over 5%. Cash investments, they're not doing this now, but have probably averaged 3 or 4%. Now, again, for the long term, when we start young, most people like to put a fair amount of their money into stock-related investments in the hopes of getting that 10 or greater return on the money. But again, as we get closer to retirement, probably is wise to take some of that out. Why is that? It's because while stocks might average 10 or 11% over the years or even more, the truth is that's an average. They can go way up, they can go way down. And if you're going to need that money at a moment when the stocks are going way down, you could be in a world of hurt. So again, why not think about getting some of this money into more tranquil investments? Again, bonds, cash, things of that sort. So hopefully you'll have more money going forward. Now, one last thing I will tell you. They used to tell people going into retirement to put all of their money into bonds and cash. And then a few years ago, somebody woke up and said, well, duh, people are not dying at age 68 anymore. Lots of folks are living 30 years into retirement and more. So it might make sense, even in retirement for some of you, while you're putting more into bonds and cash, to still leave some in stock-related investments in the hope that maybe you will get a greater return long-term on those. Hey, I'm Steve Diggs. This has been The Big Picture. Catch you next time.